Hello and welcome to The Real Economy with a focus on the middle market and the economic headwinds facing it. I'm Gigi Stone-Woods, your moderator for today, and we're going to be talking about the big questions looming around a potential recession as well as persistent inflation and the big question of the day, the debt ceiling showdown. We are joined by the one and only Joe O'Neill of the Joe O'Neill Show, Joe Brusuelas, Chief Economist at RSM, and Neil Bradley of the Chamber of Commerce. Thank you both for being here today.
Great to be with you.
You both have been wildly busy helping businesses navigate these uncertain and turbulent times. The big question everyone is looking at is the possibility of a debt ceiling impasse. This is not the first time Washington has faced the potential for a catastrophic default, and yet there seems to be more fear out there this time. Where are we right now on the debt ceiling crisis?
Well, maybe I can start with a little bit of the policy, and then Joe can talk a little bit about some of the economic consequences at play here. So we're a couple weeks out from what we believe to be the X date on June 1st. I think you're right, there is more concern now, earlier in the process than we've seen even in 2011, which was kind of the last time that we had a situation similar to this, divided government, protracted negotiations. I think one of the reasons that this seems a little bit more uncertain, and in fact is more uncertain, is because the negotiators got started very late in the process. So if you go back to 2011, there were discussions that stretched months between the then Obama administration and congressional Republicans. We really just started negotiations last week, and the clock is ticking. I think adding to that uncertainty is it's just harder for Congress to do things these days. And so even when they come to a deal, and I do believe that they will come to a deal, that we will pass it, it will be enacted before the deadline, it's just going to take longer than we anticipate. And so they're having to build in some extra time that frankly they don't have to be able to reach a deal, pass it through the House and the Senate, and get it to the president's desk.
You know, I think that when you take a look at the financial markets, especially the front end of the Treasury curve, you can see severe distortions. The price of 1 month yield at above 5.6% this morning. Now that's a record. That's something we're probably not going to see outside of an isolated crisis like the one we're approaching. So markets are pricing in the potential of a default. Now, I think that's around 10%. Now that's may not sound like much, but that's a non-trivial number underneath or within the context of these conditions. So there's a real risk here that if the political authority fails, we could see significant dislocation across asset markets, across the banking sector, and really households would feel this very quickly, which is why it's encouraging that we're beginning to see deeper, more sustained engagement here in DC so that we don't hit the X date and flirt with disaster.
Right.
Yeah, to Joe's point, he says a 10% risk on something that's supposed to be risk-free.
That's right.
The reason this is so important is treasuries are risk-free, and we build everything else on top of that assumption. So when we get to a 10% potential probability, that's a really big deal coming off of zero.
And it's important, everybody who's listening in on this broadcast or watching, that we communicate just how important U.S. treasuries are, not just here in the United States, but around the world. Just about every single financial instrument is underpinned by the U.S. Treasury in one way or another. And of course, the U.S. dollar being the preeminent reserve currency plays a unique role. So the U.S. credit rating's at risk. There's so much at risk here for what is essentially an artificial crisis. And it's something that should get done now. There needs to be that fierce sense of urgency to come up with an equitable solution so we can move on to more important and more pressing matters.
Yeah, Janet Yellen is saying we could run out of money by June 1st.
Yeah.
And President Biden is being optimistic. Kevin McCarthy, not so much. So it seems like there's this sort of dangerous game of chicken going around. What are your worst fears about the possibility of a debt ceiling impasse?
Well, my worst fears for obviously that would lead to a default is simply a miscalculation. So, there's politics at play here. And so, yeah, in any negotiation that's playing out in the political sphere, you're going to have the yin and the yang. If one side sounds optimistic, the other side is going to sound pessimistic. If one side says, I'm open to that, the other side is going to say it's a red line. That's the nature of these negotiations, particularly as they play out in public. I don't believe either side, anyone at play here, wants to flirt with a default or to actually cross that line. The danger becomes is that you're pressing your advantage, you wait till the last minute, and you assume at the last minute that there won't be any hiccups, that you can get the legislation drafted, that you can get the votes in the House, that you can get the 60 votes in the Senate, or you're counting on things going faster in the legislative process. So the real danger is that you press, you get to the last minute, you have a hiccup, and then you stumble your way into default. Because at the end of the day, the money that's in the Treasury is the money that's in the Treasury. You can't, this is the point, right? You can't make up more money, and you have bills that are going out the door. So they are gonna have to act, and they need to leave themselves some more time so that they don't miscalculate.
So my biggest fear can be summed up in one phrase, interbank lending. I wake up one morning to find out it's frozen. What that means is the flow of liquidity that serves to make mortgages, that makes auto loans, student loans, that we need to use to make pension payments, i.e. Social Security payments. Once that begins to freeze up, and if this goes on for a couple days, this could get very dangerous. It'll look a lot like what we saw in October 2008, right? Where we started to wonder if, hey, on Monday, are the ATMs gonna work? Yeah, if these things, like you said, a miscalculation that results in an extended debt ceiling debacle, you really are playing with fire, which is why it's good that they're doing this now.
And the repercussions could be long lasting.
Yep.
Presumably there's going to be a deal. No one wants this to happen. What would success for a debt ceiling deal look like?
Well, success is ultimately getting it resolved. It has to be bipartisan in nature. We're in divided government. Democrats control the Senate and the White House, Republicans control the House. So they have to do this together, which means that you need a deal with both sides get to declare some victory and neither side has to cross a red line. I think that probably what that tends to look like is things like rescinding unspent COVID money. There's about $60 billion out there. In all honesty, no one's going to know that it got rescinded if the government pulls it back and it doesn't get spent. The second is that they have to come up with top-line levels of appropriated spending. Every year the government appropriates money to run federal agencies. So think about the Department of Education and the Pentagon. At the moment, we don't have a framework to say how much we're going to spend. They could come up with a framework. It's going to be more money than Republicans want, but less money than Democrats, and that's kind of a sweet spot. And then they may include some policy measures. You have Republicans and Democrats who say that we need to reform our federal permitting process. For the U.S. Chamber, it's been a long-standing priority. We think it's outrageous that it takes you longer to get approval to build something, like a building or a road or a bridge, than it does to actually build it in the United States. And there's bipartisan agreement around fixing that. So that's the kind of deal that both sides get to look at as a win, that resolves the impasse, that doesn't violate anyone's red lines.
And then we'll define victory as a period where the yield on the 1-month T-bill is below the 2-year, and there's no shock throughout financial markets, so our small and mid-sized clients can get lending to expand their businesses and hire people. So that's how we'll define success coming out of this.
You know, all of this is happening with this threat of recession looming. Yeah. How likely is it at this point, and what kind of recession would it be? Garden variety? Would we have a soft landing? Where do you see this playing out?
All right, so this is the most well-telegraphed recession in all of human history that just doesn't seem to happen. So right now, when I'm going around North America and I'm talking to clients and in the public about what's going on in the economy, I start out with, we're using the wrong R word. We should be talking about resilience, not recession. You know, you think about the shocks that have happened over the past 3 years. The pandemic-induced shock, the supply chain disruptions, the inflation and the interest rate shock that have all happened. It's amazing that we haven't fallen into recession already. Now, we do think there's a 75% probability of a slowdown over the next 12 months. Now, you got to temper that with, well, that means there's a 25% probability, which is non-trivial, that we come in for a soft landing. So right now, there's really no indication other than the pullback by very large firms of investment in capital expenditures that we're in recession. As a matter of fact, we had retail sales this morning, very strong. San Francisco Fed put out some really good research and data over the past week. It told us that there's about $500 billion in excess, excuse me, $500 billion in excess savings sitting in Americans' pocketbooks. That's sufficient to support solid to strong spending through the remainder of the year. So at this point, our model, even though it says 75% probability, doesn't indicate an actual recession starting until first quarter 2024. And if we keep hiring people at over 200,000 a month, if wages keep increasing at around 4 to 5%, the probability of a recession, I think, will begin to dim.
And that's how you think we've been able to stave off a recession
That's
so
right.
far, consumer spending.
And if we do have a recession, it just seems to me it's likely to be an inventory correction, probably in the manufacturing sector linked to autos. So right now, it's just not there. And if it does, it's something that's not, for some households in areas of the economy, they'll hear about it, they won't like it, but they won't feel it. It's why when we ask individuals, are you satisfied with your job? Highest job satisfactions on record. Why? Jobs are plentiful and wages are going up. They don't like the rancor coming out of DC. No one likes the partisanship that's going on and the polarization. But when you get down to brass tacks, I like my job and I like where my life's going.
One thing they are feeling, though, is persistent inflation.
Yes.
So what are the factors that are consistently keeping inflation up?
Well, right now, what's driving inflation is largely demand for services in transportation. I had a real interesting time getting from California to Washington, D.C. yesterday. And that's what life's going to be like this summer for people who have to fly on business, or they're taking their kids on vacation, or they're going home to see their parents, right? The cost of moving about the United States is very expensive right now, and that's the main driver. Okay, second, even though the domestic supply chain's improved noticeably and it's normalized, there's still real problems around the world in getting things, shipping things to even our friends in the UK. It can be very, very difficult. And so the underlying pace of inflation right now, if you look at the consumer price index, is between 3.5% and 4%. If you look at what's called core inflation, it's around 4.5%. It's a lot easier to get from 9 to 8 and 7 to 6 and 6 to 5 than it is to get from 5 to 4 or 4 to 3. So inflation right now is a bit sticky and it's a bit stubborn. And it's understandable that people are upset about this, right? The price of food, even though it's beginning to noticeably ease, for many households, it's still expensive. And I get that. It's something that inflation becomes an emotional thing, and people will be upset long after it's somewhere between 2 and 3%.
And Neil, let's talk about possible solutions. How do we help bring down inflation, and what can middle market businesses do to prepare for a potential recession?
Yeah, you know, on the inflation side, it's the classic too much money chasing too few goods. And so whether it's the Fed's money supply or what we did through the fiscal authorities in the pandemic, we put a lot of money out there. Now, initially, we couldn't travel. We couldn't go out to eat during the pandemic. So we still had money, so we substituted goods, and we had all the supply chain disruptions. And so what Joe described initially took place. We were renovating our homes and building new places, and people wanted to redo the kitchen because you were spending so much time in it, right? All the things that we all did. So at that moment, we saw real goods inflation. Well, now we want to make up for the experiences that we missed out on. We want to get back out to our favorite restaurants. We want to get on the plane, this summer and take our family on vacation. And so now we're in a services side. In particular, that can be sticky with inflation in a moment in which you have a really tight job market. And that's what we have. Not only are people satisfied with their jobs, we have generational low unemployment, and we have more open jobs than we have people looking for work. We're coming down off some highs, but it's still ahistoric relative to the tightness, in the labor market, which means that service-intensive or labor-intensive services, it's a real pressure. I think one of the things that we could do in this moment is figuring out how we grow the labor force. So some sensible immigration reform, tight restrictions there. But let's be clear, there are no quick fixes here. It just takes time to get more people, to get people off the sidelines, to get a labor force that matches the demand that we have. In terms of the recession aspects, Joe said something important about thinking about your individual industries and where you are. I think the thing that we often tell our members, because we represent all industries at the U.S. Chamber, is be very particular about your own data and what's happening in your industry. we are in a moment where it's easy to get swept up in overall moods and thematics. That if you survey people today, including business leaders, if we're not already in recession, we're heading to a recession tomorrow. The pessimism just kind of drips. If you ask them about their own business, their own business is doing fine. Demand's high. And so, in some ways, you just got to be really focused on the data in your own business and don't let yourself get swept away in kind of these broad views that may not reflect reality.
We're short 2.6 million workers compared to the pre-pandemic levels. And they're primarily 55 and older who've exited the workforce, or the long tail of the pandemic is creating issues with them working in traditional ways. And when you look at prime age workers, 25 to 54, well, we're back above where we were in the pandemic. So it's difficult to get people. Once you get through the sort of the moaning and groaning about how terrible things are, well, what are you doing? Oh, I'm hiring, I'm paying more, and we're investing. What's your number one problem? I can't find enough people to do our work. We have actually good problems right now in the economy, despite the inflation and interest rate shock, right? So, you have to take it with a grain of salt. I think once we get through this period and we begin to see the promise of all the technology that's out there, I see nothing but a real increase in productivity. I see young people really beginning to remake the economy in their own image, and I'm very optimistic about where they want to take it.
And that's a looming question, just in the cultural zeitgeist. Everyone wants to know where artificial intelligence is heading, what jobs it's going to take away, how it's going to affect the U.S. economy. What are you hearing?
Okay, so when I think about artificial intelligence, I think that there's three pillars. The first is the pillar around machine learning. Now, this isn't new. This has been with us for a while, right? It's statistics, inference, econometrics, predictive analytics. Big firms have been using machine learning for quite some time, and it's being integrated in an accelerated way across the economy. The second pillar is what we'd call generative AI. Now, this is the chat bots that we're all experimenting with, right? And that the technology that's as a result of this is it's allowing us to become much more efficient. The first of the scalable tests are now being run. There's a great paper out by a guy named Eric Brynjolfsson, who used to be at MIT, who's now at Stanford. And they did the first scalable test on integrating generative artificial intelligence into an actual call center. The results were fascinating. A 14% increase in productivity with no disruption of employment. Okay, this is not the dystopic hellscape that people talk about. This is actually, hey guys, there's going to be a productivity shock that's positive, that's going to allow us to take people who are willing and able to adapt to this new technology and help them move up the value chain so that they can do more important things for the company and we can actually serve more people. This is very, very exciting. And then the third pillar is what's called artificial generalized intelligence. Now, this is very out on the frontier, very sophisticated physics and engineering, things that it will allow us to solve problems that we hitherto wouldn't have even thought. So I'm more of a techno-optimist when it comes to this. Now, we don't want to be Pollyannish about this. There's going to be some technological unemployment. In 1950, when the direct dial phone was introduced, it put a lot of women out of work who were primarily connecting wires to tubes to connect calls. And within 5 years, that whole industry had been transformed. So we've been through these things. We understand how to adjust to them. But we have to get through that sort of the cultural touchstone of, I've watched the Terminator one too many times, and this is going to end up wiping out humanity. I'll take the other side of that bet. It's going to make us better. We're going to do good and great things with this.
Let's hope you're right. Before we talk about the far, we talked about the far future. Let's talk about near term. We're trying to figure out what is going to happen with interest rates. There seems to be some dissension among the ranks over at the Federal Reserve. So what do you think is going to happen in the near future, and how do you think interest rates are going to play out?
Well, I think there's dissension because we've reached the point where we have difficult trade-offs, right? It wasn't difficult at 9% inflation and near zero interest rates to know that we needed to do something. Now we're all trying to divine where we're at in the economy and the implications if we take a pause, that inflation would be persistent, versus the implications if we don't take a pause, that we might slow the economy too much. And so, I think the dissension is in some ways a good thing, because it's indicative that we've gotten to a point where we're having to make these type of trade-offs. I'm not going to venture a guess as to how many more rate increases that we have and when exactly we have them, though it does feel like that if your assumption is that we're done with interest rate hikes, that doesn't, to me, quite match where we are in the economic moment.
Okay, so I believe it now appropriate that the Fed take a pause to ascertain the lagged impact of past policy hikes, and also to acknowledge the real risks around the outlook. A, linked to one, the debt ceiling, and two, the issues in the banking sector. It's probably a good idea that they just take a couple months off to just assess what's going on. Now, if you ask me what's the next likely action, a hike or a cut, I'd say, well, if something would occur in this last 4 months or 6 months of the year, you'd probably get another hike or two, given where inflation is. Again, underlying inflation in the CPI is between 3.5% and 4%. If they want to get back to 2%, they may need to hike further unless they get a couple breaks. Core inflation's at 4.5%. That means it's, with inflation being sticky and stubborn, it's going to be very difficult for them to engage in rate cuts this year. My sense is if we have rate cuts, it's because A, there's a recession, but B, that's a 2024 question, and we'll have plenty of time to get to that. But for the remainder of the year, it would probably be optimal if the Fed just kept the federal funds rate between 5 and 5.25%, and we'll see how the economy performs. Now, my sense is the increase in rents, which is driving the CPI away from transportation, is peaking right now in the series. Real data shows it's already rolled over. So in the second half of the year, we're going to get some real assistance in terms of bringing down the top line number. And of course, those year-over-year base effects from oil peaking last year at $120 a barrel, moving from 80 to 120 in just a couple weeks, and now sitting at around $70 a barrel. Yeah, we're going to do very well on the inflation front here through the remainder of the year. And then the best research indicates that the public wants inflation somewhere between 3 and 4%. Let me give you guys a hint, they really don't care. And then we can begin talking about a different economy. But we still have to put inflation back in the box and get it to a tolerable level. For me, that's around 3%. If we're there, I think we can all get on with it.
One looming question, of course, is the stress on the regional banks and whether there is an appetite for congressional intervention in terms of insurance caps on deposit insurance and lifting them. So where do you see that going? Is there an appetite for that? And what could potential unintended consequences of making changes to that be?
Well, I think that it's very important that we recognize the current regulatory framework where you're insured up to $250,000 was constructed for 2 or 3 economies ago. When I went out and talked to the clients during the worst of the banking disruption, what I heard was that, hey, you know what? We've got a North American business. We employ several thousand people, and we've got, 2 to 5 million sitting in sweep accounts that don't earn anything, that are uninsured. And I kept hearing this similar story. Yeah, we need to change. We need to modernize the framework around those insurance deposits to accentuate the needs of small and medium-sized businesses that employ the majority of the population, that we can't allow their capital that they need to conduct daily business operations and meet payroll to be put at risk by a combination of lax risk management at some banks and some of the risks around normalization of interest rates.
I think in the same way that the 250 in the current limit reflects economy several times ago, we're going to have to think differently as we update a deposit insurance system. So I suspect, and I think this is a good thing, I think policymakers are going to take their time, because in taking their time, you don't knee jerk to, well, the 200 should be 500, and this is the base cost of the insurance that we'll pass along. Because if you're at 500, we haven't solved the sweep problems for, and so I think we're going to end up thinking about this hopefully a little bit differently.
Lead management to take perhaps too many risks.
Well, or to the extent of which are we relying on businesses who are having operating accounts as being a check on bank management? My guess is that's probably not a very efficient way in a system of having kind of checks and balances. So you may end up in a situation where we differentiate business operating accounts from individual savings accounts, et cetera, and that might end up being a good thing, and that'll also help us manage some of the real costs that will be imposed on the banking system for providing that type of insurance.
And it was only 15 years ago when we saw bank runs around the great financial crisis, and you saw people lining up. That's not what happened here. People simply opened their iPhones and moved their deposits. We've had some massive structural change in the banking sector and
It's a
economy.
Wonderful Life.
That's right. No, it's really not. And unfortunately, that's how it's presented all too often. So we need basically to modernize that framework. And look, there are going to be some issues in the banks. There are going to be some real challenges in commercial real estate. And we need to get out ahead of this. And it's one of those times that it would really be beneficial if the political authority could approach this the same way they approach, say, the CHIPS Act. Identify this as a national priority. Associate it with not just in that case, the national security interest of the country, but in this case, the interest of the public and their employment. We need to keep that stable as we move, through a period that's going to include a lot of rapid change.
And to that point, right, by the way, CHIPS wasn't a fast process.
No.
They spent well over a year and a half, even longer if you think about some of the private discussions that took place, even going back to the prior administration kind of figuring this out. And so I don't know if it's going to take that long because we do have some pressures, but that type of model that Joe just talked about is going to produce a lot better results than essentially trying to legislate or make changes in the midst of a crisis.
You mentioned the commercial real estate problem that is likely to unfold over the next few years. Who is going to be okay and who's going to have more of a problem according to the businesses that you communicate with?
Well, so there's no question that if you're in an urban core that relied on people coming into an office building and now you're at 30% vacancy rates and people coming in, you're going to have some difficulties. So we were building office space in core urban areas for a work model that just hasn't fully returned post-pandemic. So if you're exposed to that on the banking side or the investment side, or you happen to be one of those owners, or you happen to be one of those municipalities, you're going to be impacted by that. It will not be even kind of across the board. You can go from city to city and you see pretty significant variances in where they are in terms of commercial vacancy and people coming back into the office. You do have people now moving headquarters and office space into the suburbs. So I think that the thing that we see is that you're not going to be able to draw an across the board kind of description of what's happening in commercial real estate, other than to say, as a sector, it's going to be more pressured and have more downside risk than many of our other sectors. Once you get past that layer, you're going to have to ask a lot more questions to understand who really is at risk here.
All right, so there's 1.5 trillion loans that are going to need to be rolled over that were made between 2 and 4% that are now going to be rolled over somewhere between 6 and 10%. This is over the next 18 months. If you think about commercial real estate, you think about A-class buildings, those are the new ones that have been built over the past several years, B and C. It's largely going to be in the B and C class buildings. Now here's what I'm somewhat worried about. It's all too easy just to say this is a problem in Chicago and New York and Los Angeles and San Francisco. Yes, 70% of the loans, commercial real estate loans, were made by those local and regional banks to the major metros. But what's not well known, and I think needs to be talked about more, is those same small and local, or same local and regional banks, they make 90% of the loans outside of the major metros that go into commercial real estate. And those are often in that B and C class. This is not just a New York problem, and I'm afraid it's going to be cast as that over the next year, when the truth is it's going to be out in the burbs, right, where people live, where people work. And it's going to demand some creative policy approaches and a framework. by Washington in cooperation with the states in order to make sure this doesn't mushroom into a much bigger deal than it needs to be.
Speaking of creative solutions and creative approaches, I do want to go to audience questions, but before we do, I know that you like to come up with solutions and suggestions of things that we can do to help the economy. So what is the chamber thinking about right now?
Well, when we think about the economy, it's actually something Joe and I have talked quite a bit about on past episodes of The Real Economy, which is if you think about if we do head into a slowdown, if we do head into a recession, where can you support the economy in the quickest, easiest fashion? And one of the things that thankfully we've done because the CHIPS Act, because of the bipartisan infrastructure bill, because of the energy provisions of the Inflation Reduction Act, is we've poised for a lot of capital investment that could go into construction and modernizing our economy. Our biggest hang-up at the moment is accelerating the deployment of that capital to meet the moment where if we have an economic downturn, to help soften that. So this is where the push for permitting reform comes in. Most policymakers don't think of it as kind of a counter-cyclical policy at the moment, but it actually could be because we might actually get the timing right if we could just speed up the permits and get shovels in the ground to get things actually moving to coincide with 2024 and any potential downturn that we might have.
My sense is whether we have a downturn or not, it makes sense to pull forward the infrastructure spending that's on the books and to get that moving. A, it's beneficial to what's going on in the economy. B, as housing slows further, there's probably going to be some unemployment. Those guys can go to work over there on the other side of that industry, and I think it really would be beneficial if Washington in general and the Secretary of Transportation in particular begin talking about it in such a way. I think it'd be very well received.
Okay, see who's listening. We do want to go to audience questions, so I have some good ones right here. Going back to the debt ceiling, of course, that's what is at the top of mind for everyone. Why not simply do away with the debt ceiling? Many consider it an antiquated policy tool.
Well, in many ways, it is an antiquated policy tool. Understand how we got to the debt limit a century ago. Prior to World War I, every time the Treasury wanted to go out and sell debt, Congress had to vote and say, yep, you can go out and you can sell X amount of debt. And so a century ago, a debt limit was actually a reform to make the process easier, simpler, more predictable. In the recent past, say 1980s, really up to this moment, it has served as a point of discussion about the fiscal health of the nation. It is important that we have moments in time where we discuss the fiscal health of the nation, where we stop and pause and say, is our revenues matching our expenditures? Now, unfortunately, we'll see as we get through this moment, we may be reaching the point where it no longer serves as that useful of a tool as it did in the 1980s, the 1990s, and maybe in the early 2000s as being that moment to begin thinking about our fiscal health. I would say that if we ultimately get rid of it, we should find another moment to have discussions about our debt and deficit, because we do have long-term challenges. We cannot continue running trillion-dollar-plus deficits in good economic times and assume that that won't have consequences. Just the interest rate
down the road.
Well, the normalization of interest rates are not high interest rates. Normalization of interest rates means that we'll spend about 3/4 of as much as we spend on national defense, we'll spend on interest on the debt. That's probably not an allocation of federal resources that any one of us would make if we were having a rational discussion to decide how to allocate the dollars that the federal government collects. So if we do replace it, we need to replace it with something that makes sure that we have this moment in time to think about the trajectory of our nation's finances.
This is the fourth debt ceiling debacle in the past 12 years. This is in no one's interest. It puts at risk the U.S. credit rating, the dollar's reserve currency status, and carries risk for average households that simply, one would think at one point the political authority would just say, maybe this isn't in our interest at one point, and it might be a good idea that this would go away. Or the old football coach of the Tampa Bay Buccaneers one year when they went 0-14, the press asked him after a very bad loss, what did you think about your team's execution? He said, I'm for it. And maybe that's a good way to think about this, that when you have a situation, or if things go on bad or long enough, they usually end.
Yep, very good question. So what role is our next audience question? What role have excess corporate profits played in the era of inflation? Interesting.
Well, in my estimation, we need to be careful when we say excess profits.
Yes.
Right? Because
It's a loaded question.
Yeah, it really is. No, that's not what's caused the inflation. Inflation was primarily caused by the pandemic era, global supply shocks, and then excess fiscal and monetary policy, which, by the way, that extra $500 billion sitting in household accounts is getting us through this very difficult transition. In a few years, we may have a different view of this. But definitely monetary policy and fiscal policy did play a role in inflation going from 1% to 9% in a short period of time. We're back down to 4.9%, right? But the idea of greedflation, that it's excess corporate profits, just rings hollow. And when you really put it to an empirical test, you know, like a lot of things, once reality meets the data, usually reality tells you what's going on, and it's not corporate greed here.
Two quick things. Sometimes I think we forget about the function that prices play in an economy. Yeah. Prices are how we allocate resources. And when resources become scarce or demand is too high, prices rise so we can figure out how to allocate them. If supply is abundant, if demand is low, prices fall because that's how we allocate it. Particularly during the pandemic, we saw in certain sectors, prices rise because we were trying to allocate a scarce amount of goods to meet a whole lot of demand. That is a whole lot better than the government deciding how to allocate resources. And so, you know, it wasn't that long ago that some politicians decided that the whole reason that meat prices at the grocery store were up, must have been because of the corporate meat processors were taking too much profits. And you know what? Their profits were up during the period in which demand exceeded supply. Go take a look at what's happening to them now, because supply has expanded and demand has returned to normal or cooled somewhat. And now they're having a really difficult time, those corporations. So that's the nature of what you want to see in a free market economy. That's actually a signal that prices are doing the exact thing that we want prices to do. Because the alternative is that we don't set prices as consumers or as business leaders, that instead government sets prices, and that ought to scare everybody.
Yeah, an efficient market. And I think that was a good question because so many Americans really do think about corporate excess greed, and you explained it.
Just think about the price of gasoline. 1 year ago, it was $5 to $6 per gallon in many places. Now the average is about $3.50. When I left Austin last week, I could fill up about $2.90. So that's why you want prices to adjust. Change in price equals a change in behavior, and that's a good way to organize your economic system.
Let's go to another audience question. Will businesses such as restaurants and grocery stores decrease prices if inflation decreases?
It depends upon the composition of demand and where you are. Right? Where I live, there are too many people trying to squeeze into one spot. It's impossible to get into restaurants. Prices are going to remain elevated based on demand. Right? I mean, it's just really going to depend where you live and the conditions that are, prevail there.
That's exactly right. And in the grocery store aisle, yep. You've already seen coming off peaks as more supply. I mean, it takes a while to get a chicken, to get a pig, to get a cow, but the market responds, and it was seeing the excess demand. Now, in some ways, supply is elevated, and prices have adjusted accordingly.
I mean, the price of eggs, right? Yeah. 6 months ago, that was the price du jour. If you're worried about inflation, it's mostly normalized. I'm not hearing it.
Yeah. Because we had a supply problem,
That's right.
in part because of a disease amongst hen-laying birds. we've now overcome that. Supply is caught back up and prices are normalizing.
Okay, well, you can both run for president now that you actually know the price of eggs, because that's something that they always get stumped on. Okay, going to a different topic, why not have federal agencies, another audience question, not my own, why not have federal agencies, including the Federal Reserve, simply contribute some of their treasuries back to allow cushion in the debt ceiling?
Well, the excess capital that the Fed accumulated has been going back to the Treasury, and they were a net exporter of profits back in the Treasury for many years. We just don't do a good job of explaining that.
And from a legal standpoint, the debt limit covers both intergovernmental debt and public debt. So the treasuries that are sitting in the Social Security Trust Fund account equally count towards the debt limit as those that are being traded publicly today. And so Congress could change that, just like Congress could get rid of the debt ceiling if it wanted to. But that's the reason that the administration can't act in such a way as to alleviate debt limit pressure by doing what the viewer suggests.
Okay, well, I'm going to return to some of my own questions while we wait for more audience questions. One thing that we haven't gotten to is the concern about increased tensions with China, and which really have been going up over the past few years. Do you anticipate that to continue, and how could that potentially impact the U.S. economy going forward?
Well, most of my career arc was post-fall of the Berlin Wall, the era of globalization. All right, that era of hyper-globalization has probably come to an end. That we've now moved into a different era where national security and trade concerns are paramount, and we've imposed industrial policy, which has bipartisan support. That area of pure free trade, free movement of people, capital, well, that's going to be constrained a bit. It seems to me that we've entered an era where the de-risking from China, and in some cases the outright decoupling, not just among the United States, but the G7, well, that's going to continue. It's going to get very intense in the technological sector, especially around artificial intelligence, because both the US, China, and their trade partners want to set the standard. So the competition is going to be fierce, and there's going to be disruptions. My estimation, it's going to result in higher inflation than what we've become accustomed to the past 30 years, and higher interest rates than we've become accustomed to over the past 20 years. And that's just going to do with the different geopolitical tensions that we now face. As an economist, I have nothing to say about that. I'm just trying to figure out what's happening now, what's likely to happen in the future. It's why I think the Federal Reserve is inevitably going to have to reset their inflation target to 3%, not because of the internal workings of the economy, but because of the external geopolitical tensions and decisions by the federal government.
China's complicated, right? We're talking about a $1 trillion commercial relationship between the U.S. and China. As anyone who's picked up a paper recently has seen, the Chinese are in some ways getting more aggressive on both a national security and an economic security standpoint in terms of a threat to the United States. And so when we talk to policymakers, you know, if you're talking about semiconductors, if you're talking about telecommunications, if you're talking about AI and supercomputing, there are real risks here that we have a responsibility as Americans to take steps to protect both our national and economic security. However, that is not $1 trillion worth of commercial relationships. We're talking about a subset of the relationship. And so the great challenge I think that we face is being serious and sober-minded about the real challenges and the real security threats and doing things to address them. Again, things that conflict with globalization, right? And so you're talking about export restrictions and entity lists and the like, but not confusing that with sending movies to be aired in China, with us buying clothing and baseball caps, with us selling them soybeans and meat products. And so in some ways we have to differentiate the places where we have threats versus the places where if we overreacted, it would actually hurt our own economic self-interest and our own ability to be a resilient country and to respond to the actual threats.
Okay. I have some more audience questions, but while we're on the topic of trade, I feel like the West Coast port slowdown hasn't really been getting enough attention. And I was just curious your thoughts on how that is going to impact the U.S. economy.
They've made a lot of progress over the last several weeks, and knock on wood, they'll make even more progress over the next several weeks. And I think, unlike railroads last year, I think we are on a pathway that averts major shutdowns or a stoppage. I think that's the reason you're not hearing about it.
Great, I'm glad I asked. All right, so another audience question. What is your assessment the impact of CARES Act programs such as PPP loan forgiveness and ERTC credits contributed to inflation?
No, I don't think that was the primary driver of inflation. I think the wage substitutes during the first year of the pandemic really helped smooth the transition and created that V-shaped rebound that we saw in 2020. There's an unfortunate trope out there, I think, that there's still pandemic era government transfers going on, and that's just not simply the case. They ended a long time ago. In fact, my sense is that a lot of the money was put into savings accounts, and it's helping us transition right now. That's why there's that $500 billion in excess savings out there in Americans' checkbooks.
Okay, so all of the questions so far have been anonymous. We have a brave asker here, Brandon from Silverleaf Partners. Thank you for being honest about who you are. He wants to know, do you believe the U.S. regulatory framework is ready for the short-term disruptions that may be caused by AI? And if not, what more should be done?
Absolutely not. They are absolutely not ready for this. There's both a danger in underreaction and a danger in overreaction. So, we need a framework. If you think about the framework that gave us the internet, and that Congress and regulators thought about in the late 1990s, it was really one that said, what are the unique problems that the internet could present? And let's address those unique problems, and let's let other regulatory authorities that govern other aspects of the economy that would be applicable here to govern. We need to do the same thing with AI. So to the extent that we're concerned about bias and discrimination, we have rules and regulations around that, and that we can cover that. There are some unique aspects, particularly around intellectual property, for example, that we're probably going to have to update our regulations and our legislation for. But we should be as concerned about overreaction as underreaction, and hopefully we'll replicate what we did in the 90s, and this will be much better for the positive vision that Joe has that I tend to share about the future of AI.
Less is more here is a good way to approach this. I think open source is better than closed source. Do not allow the companies that at least have scale right now to pull the ladder up and keep competition, prevents competition, because we're going to need more competition, not less, in this new emerging era. One of the things I'm confident, though, if we allow the federal government to put a regulatory framework that's too large around this, they're going to put an analog framework forward that's profoundly not appropriate for a digital challenge. And I think that's probably a good way to think about this going forward, because again, less is more here, at least in the initial phase. Then once we can have a rational, full-throated debate, which Americans I think are very good at, we'll figure out a way forward.
It was interesting. I was watching the local news last night, and for the last month, you've heard stories on the news about people receiving a call with a voice on the other line that's a loved one, that's an artificial intelligence impersonation that's defrauding. And we all have that exact same way. It's scary, right? And we're like, what are we going to do about this? But the story I heard last night was a company that is unveiling a new service that's able to detect and pick up when the voice on the other end of the line is artificial intelligence. So in some ways here, we can get really worried, appropriately so. It's a scary proposition, but it's amazing how much the free market and innovation can kind of come to the rescue and solve some of these problems. And I think we ought to be reassured by some of the worst excesses of AI and the threats actually being solved by people who want to do good with AI.
It's like
and that's a
students
positive.
cheating on tests, and then the software that will combat that will be able to detect it. It's going to be quite a rat race.
Yeah, exactly. And that's a good thing. That's how you get innovation.
Right, absolutely. You know, we haven't really talked about the sort of talk out there about the US dollar losing its status as a global reserve currency. I know this is something that you have written about, Joe. Do you think this is actually likely to happen? Is it premature?
No. The absolute answer is no, it's not going to happen. The US represents 60% of all currency reserves as things currently stand. The decline from the peak of around 75% had to do with the introduction of the euro 20 years ago. It was natural that that was going to occur. In fact, it's a little surprising it hasn't occurred at a faster pace and in a more intense fashion. So I think what we're going through is a period where just 6 months ago, the dollar was above parity against the euro, and it's now trading at around 110. There are individuals in what we'll loosely call cyber assets who are very good around setting the terms of debate in the social media sphere around the dollar, and it creates a lot of noise. But one of the things we know about cyber assets is once you push on it a little bit, well, it tends to collapse. So no, the dollar's not going anywhere.
Okay, we have time for one more question. We have a good audience one. How do you think the $500 billion in excess savings will eventually be spent? Are people waiting to buy the dip?
Well, my sense is that the households where the savings are clustered are predominantly, well, we'll call them upscale, and that, yeah, you're likely to see some of that money move into assets once we get through the debt ceiling situation.
Okay. Thank you for joining us both to talk about the changing economic landscape. Your advice has been illuminating and helpful and great analysis. Joe Brusuelas, RSM Chief Economist, and Neil Bradley of the Chamber of Commerce. Thanks so much, and thanks for watching. This is The Real Economy.